Welcome to StockOdds Odds and End podcast. This is Dave and Rob getting ready for the week ahead. We're on Saturday finally, back to our normal schedule. How's everything,
Yeah,
Rob?
that's good. It's good. Thank you for being available. Appreciate it. And let's won't be too long today, so get it running here. We've got the SPY daily chart I want to talk about. And last week, we ended down there with a indication of potential slight turn. Um, because we had gotten kind of back to our consolidation area. When we talk about mean reversion, this is always how I think about it. Where did we spend a lot of time and that we took off from? So we launched out of that area and then we kind of came all the way back to that area. And the same thing here, when we launched up, where did we go back to this 5-6 days of consolidation? So that's how I always view mean reversion is not something purely mathematical, but more or less a visual cue too, where things have spent a lot of time consolidating, and that means that there's probably a fair amount of committed people that got stuck. So when it gets back there, they're thankful to get their money back, and yeah, it's always been interesting. So that's an example this last week here of moving up and mean reverting. So the 1 day performance was green, just like on Thursday, we had all of the sectors green, and then Friday energy was off, but the rest were green. Real estate has really been benefiting from the change in the treasury yields. So that's why it dominated on Friday as well as for the week. You can see it up 8.84%, which is phenomenal. Consumer cyclical benefits as well. I mean, this is a good time of year for cyclical as we head towards Black Friday. And so the seasonality tends to be there anyway, let alone the fact that we got some cues from the FOMC about maybe we're done with rates, and the market's responding to that. Financials, they're seeing a bit of relief of pressure. They have a lot of held to maturity stuff that got basically recategorized. It was available for sale, but got changed to hold to maturity. But they're still underwater significantly. Bank of America, JP Morgan, lots of the other banks have a lot of unrealized losses. And if the treasury yields swing back, that can relieve the pressure on some of that. So I think that's why the financials are responding. So normally, before the interest rates ever were moved up so aggressively, we had banks responding favorably to the interest rate hikes. And that's because money center banks can, usually do pretty well, make more money from that. Regionals have never responded quite that well to the hikes, but money center banks certainly. But then because of the speed at which the rates were moved up, and how far they went, I think that this is what caused the situation for the money center banks to have rates going higher as not a good thing anymore. And so if they relax, that can relieve the pressure. And I think that's what we're seeing here with the financials. Technology, kind of like discretionary, loves lower rates potentially, or at least rates not going up anymore. Communication services, similar. Utilities, that even responds a bit to rates easing. Basic materials responds to the dollar. Healthcare, I don't think it cares too much. Consumer defensive just kind of goes along for the ride, but a lot of rotation too, where what are you going to buy? You're going to buy more growth. You're going to buy more risk on assets. So that's what we saw for the week, is more of a risk on approach. Here's how things did. We had consumer let's see, what do we got here? So real estate, again, we mentioned did the best, followed by financials, followed by consumer discretionary. And this is the sector ETFs now, so slightly different than the broader market, but very good performances across the board, with energy lagging only up 2.42%, which would normally be a good week, but not in comparison with some of these other numbers. I did find that relative volumes were kind of tapering off near the end of the week. Friday's relative volumes were not that substantial, except in the real estate area. And yeah.
We had a lot of
So
movement this week, so it could be
yeah, we
losing
did.
some of its oomph.
Yeah, that's true. And people have they already got committed, and don't have that much funds to keep chasing, right? Nor would you want to. So this is Friday's map of the market. You can see a few symbols had some of that's related to earnings when they have really bad down sessions, opposite of what the market's doing. A lot of it can be related to that. Energy's more that theme of we already had the boost from, say, concerns in the Middle East, and that's persisting, but it doesn't seem to be spreading beyond that localized stuff. So at this point, energy hasn't benefited anymore, and it's like there's other areas to invest in right now with the treasuries dropping. So the treasury yields dropping. So that's why I think it's just a lack of appetite more than too much in the macro area. There's the map for the week. You can see NVIDIA up 11%, but AMD beat it, up 16.4. Micron up 10.5. Qualcomm had good earnings, up 12.27. Amazon and Tesla up. So again, a few little red flecks, but not much for the week. So take your pick. We call this a broad market rally. So yes, the FANGs and the Magnificent Seven still dominate the moves, but there was participation, all across the board, and especially when you look in the financials here. So, even financial data like SPGI, asset management, BX, BLK, performing as well as the chips, right? So quite a broad market move. Now, here's the dollar. Look at that channel that we were in and look at the drop out of that. So we had this long move here from the middle of July. We headed up smoothly with fairly low volatility, just a really good climb with the dollar. And then we kind of got into some blue sky area, but then it stalled out, formed a channel, and now we're breaking down. So that was a very substantial move on Friday. And it potentially could drop lower. Why? Well, if the Fed is done raising rates, then you don't have an argument for a higher dollar. If there has already been a flight to quality and a defensive move into the dollar, then that they're already positioned, so there's no more need to do that. So that takes further demand off the table. And it's again one of these arguments for when something stalls out and it just can't make any more gains, fully priced, mean reversion is potential. And so we could head back towards our, 200-day MA potentially here. I wouldn't be surprised if it dropped down there in this next week or two. There's the 10-year note. You can see that meteoric rise of that since Wednesday, Thursday, Friday. There you go. So when you see the yield dropping, the bonds moving higher, this is bullish. Buy equities, even they bought the crypto, right? Anything anything sort of risk on. So those things that have suffered because of higher rates and, I'd say a higher dollar will benefit from lower rates and lower dollar. So that's the move that we had this week. And you know what? The seasonality for November is what, Dave? What's the seasonality for
It's
November?
the second best month of the year, right?
And for Russell, it's the best, isn't it?
Yeah.
Right. So you want to get back into some exposure of small caps. You want to kind of work with the more risk on assets, and that's what we had, right out of the gate here, November 1, 2, and 3. And so this week we had seasonality, which we talked about last week in our podcast. Was we had the last day of the month, then we had the first day of the new month, and then we had the first Friday of the month. And November has often shot out of the gate in the first few days. I remember one year there, Dave, we were talking about it. We got pretty much our 5% on Russell in one day instead of for the whole month, right? So
Whole month return in one day.
Yeah, exactly. So we've seen this movie before. This is not surprising. It's doing what it has done and in keeping with seasonality. So obviously, is it a chicken or egg thing? I mean, the seasonality is there anyway. The Fed happened to signal, that there may not be any more hikes. And we possibly could have cuts next year. And the reason for that, I talked about this a few times in the past, was, it's an election year. And, we've kind of seen that movie, however you come up with the reasons why, but we have seen, fiscal policies and monetary policies that support the incumbents. And it wouldn't surprise me if there was a couple cuts next year. That may not get us out of the woods altogether. Market could even respond the other way in its potential. We don't know for sure. But for now, the treasuries are rallying, the yields are dropping, the dollar's dropping, and the VIX is dropping. There's the VIX. So we had a kind of a peak here recently from the Middle East stuff going on, and even some of the U.S. government stuff. And we still do have on the horizon, right, the debt ceiling thing. So that was kicked down the road from September. So it's kind of going to be upon us here soon. But right now we've dropped all the way back to kind of where we came from. So is that an argument, Dave, that it could bounce from here? It's also an argument that it could continue lower, because what we see with this product is that it does continually, move lower, right? So so expect potentially lower volatility as we get more and more traction from the buy side throughout the month of November, and any surprises again could reverse it, headed back up. But I don't think this is a time. November is never a time to get short and be stubbornly short. It's always been a time for good breadth of the market, long small caps, long more risk on, short some of the ETFs or the bloated type stocks, potentially short some of the defensive things that don't have much growth prospects. That's been the backdrop. The only caveat to that would be, again, escalation of something that freaks people out, and again they decide to sell riskier assets and go into cash or go back into something else. I don't know, but so far this is going the way that November says to go. Here's the economic calendar. Why don't you tell us what we got going, and also then bring up some earnings if we have any earnings.
Yeah. So the theme for this week would be a lot of Fed speak and Fed reports. On Monday, we have a Fed governor speaking, Cook. There's also the senior loan survey from the Fed. And Tuesday, again, Fed vice chair speaking, Fed governor speaking, and the U.S. trade deficit numbers. But a good one to look at on Tuesday is consumer credit. Consumer credit, I think it's passed over $1 trillion, which is the highest we've had in 10 years. The average credit card debt is like $6,000. So we're seeing consumers using more of their credit. So it's going to give us a glimpse into what the financial condition is of the average consumer. Are they getting extended, or could that affect spending? So that's going to be an interesting report. Wednesday, some more Fed speak. There's four different ones. Fed Chair Powell delivers some opening remarks at a speech. Again, Vice Chair. Wholesale inventories is important too. And then Thursday is initial jobless claims and more Powell speak at the IMF. So I think it's dominated by Fed speak and maybe condition of the consumer and a jobless, so employment. So those are the themes for the week. In terms of earnings, we have a lot of earnings this week, so you'll have to cross-check your symbols individually. But we have Tuesday, there's Bumble, the dating app. On Wednesday, ARM Holdings, so it's going to give us some insight into chips. And then Disney, that's a big one. And on Thursday, there's just a lot of mixed earnings, and Friday, not much. So we already had the big, Fantastic Seven report for the most part, but Disney is probably the biggest one this coming week.
Okay. Well, Friday is not a holiday for the NYSE or NASDAQ, but it is a holiday for the bonds, and that's why there's no economic reports on Friday. It is Veterans Day, so bonds aren't trading. I mean, there are some bond products that do trade still, but the banks are closed. The bonds are not trading from that perspective. So that could mean that could be volume a bit lighter, or it could be a bit distorted if you don't have everything trading, and it is a bit of a holiday for some, right? So equities never get as many holidays as bonds do. Come back as a bond trader next life there, Dave. Come back as a bond trader. So, well, as far as what I would kind of look at this week is see what has run a lot. And there may be an opportunity for the laggers, the things that say me too, but they're just lagging. They may want to catch up, which might mean that some of the front runners do stall out a little bit and the laggers catch up. So there's always those kind of plays. Look through your groups to see some distorted relationships. If you're unsure of market direction and you don't want to take any of that exposure, then just work within your groups. Take some of your favorites. Remember, boring is beautiful. You don't always have to be involved in the news side. So go into consumer staples, a lot of boring stuff in there, and find some longs against some shorts within the same group. And as far as like our subscriber lists, neutral when you're unsure about what to do on Monday morning, which way the week's going to go. Maybe stick with the neutral list. And if you get a good read and the market starts rolling over or something, it might be better to be in the defensive list, especially after a big run. So real estate, obviously over 8% for the week. Any change in direction of the treasuries that could, because of Dave was bringing up how much Fed speak there is this week. Anything spooks the market, anything changes that, and the bonds start to sell off. That means yields will rise. That will directly impact the real estate group, probably the most. And since it had the biggest rise last week, there could be an edge that way. Okay. Hope that helps. Thanks again, Dave.
Good luck.
Have a good week. Yeah. Take care.
Bye-bye.